Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. New York and Toronto saw major corrections, and crude took one of the biggest hits it's ever seen over such a short period. Ross will tell us how that affected the Canadian dollar. He also has a special offer for our listeners. Danielle Park, president of Venable Park Investment Council Incorporated and editor of the popular blog Juggling Dynamite, gives us her take on inflation, the debt bubble, China's economy, people using their home equity as piggy banks, and the over-reliance Canada has on real estate to keep the country afloat. Plus, at the end of the show, we'll have a company showcase update from American Manganese president Larry Reaugh. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.ZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
An interesting week it was. Oh, I should say an interesting day.
Yes, Friday was a little notable, but we've been spoiled, haven't we, Ross? For the last few months, we've seen record highs set in either the NASDAQ, the Dow, the S&P, or all three at the same time. But I thought a crack was starting to form last week when the Dow wasn't in the record high crowd. What's the story behind today's downward trend? And again, a 2.5% drop. We have seen worse in the past. But is this telling us what's going to happen, or is this as bad as it gets?
This is probably not as bad as it gets because, we had a lot of internal weakness that we were talking about in the last few weeks here. The advanced decline line has just not been doing very well at all for the last 2 weeks. If you take a look at the broad indices, most of those are capitalization weighted. So the big stocks, the Apples, the Microsofts, these things are just so much overpowering in terms of the impact that they have on the indices that when you have the bulk of stocks not making new highs, and actually we talked about it a week ago, that the Hindenburg, which is at the definition being when you have over 2.2% of stocks making new 52-week highs at the same time that you've got more than 2.2 making new lows. That becomes then a sort of an ingredient for determining the weakness internally on the market. Now, there's other pieces to that equation, and we had 3 Hindenburgs within the last week. So the probability at that point is that you've got such vulnerability to any negative news, anything new that wants to come across the bow, that the market's just not ready to absorb it. And so, here we were in the last couple of days of the week. This new variant of COVID starts to make headlines, and also we got the holiday week in the U.S., so you've got very thin volume, and we get this massive break as far as the markets are concerned. But really, there were lots of red flags out there. This really did not come out of the blue. We were just waiting for the catalyst.
Now, taking a look at the individual markets, I think I mentioned the Dow last week did not set record highs, but when you have just a few stocks at the very top holding up the whole market, does that send out warning signals in advance, and were people already selling off and taking profits?
Oh, yeah. I mean, there's, clearly, if you take a look at percentage gains, not just, say, in the last year and a half coming off that March low, but if you look at percentage gains on the year, this has been an exceptionally good year. So there are people who are going to look to take some money off the table, and then they will look for an opportunity to buy back later. I guess you'd see more of that in registered accounts where there aren't any tax implications to it. But if you are a fund manager and you've got some big profits sitting there, and you get paid a bonus based upon your performance on the calendar quarter, you take a look at this and say, maybe it's time to bank some of this, especially people that have been around and have some experience over the years. You don't want to be there for that last little push. It's just not worth the risk with the money that was on the table or could be left on the table if we had the decent correction. So, it's typical, even as you move into this Santa Claus Christmas rally period, that you will get a correction somewhere from the 1st of November through the middle of December. And the break that we're seeing right now is the type of thing that's actually been very, very common when you look back at not just the average year, but you take a look at the year after a presidential election. There, we take a look at things like the Relative Strength Index, and it's very, very common for that index to come down and get oversold within that time window we're talking about, October, early November through December. And as of Friday, we've got into oversold territory. What you want to watch for is some stability to come in place. And I think, maybe you got a little bit early in the week, probably get a bit more of a shakeout, some margin call pressure on Monday. So, there could be a chance for a bounce in here. But overall, if we take a look at what's happened in the last year and a half and where we sit right now, I'd be surprised to see that there's a lot of upside potential. I think it's more of a rounding top as we move through the next couple of months.
How did crude do this week?
One of the worst items on the board. Friday was down 13%, and that ranks up with probably the worst 8 instances that I can see when I go back over the last 3 or 4 decades. So actually, we've got a research piece that will go out on the weekend to people and showing what to expect at this point. There are some opportunities that I think people can look to take advantage of.
The Canadian dollar is usually tied to the price of oil. How's it doing?
It did exactly what you would expect. I think actually the only 2 currencies that didn't do well against it, well, no, I should say the Turkish lira are probably up there as well. But the Canadian dollar and the Australian dollars were the 2 that got hit, down almost 1% on the day on Friday. So that puts the Canadian dollar down at 78 1/4. Back down, testing the lows that we saw in September, October, and definitely the a commodity currency. This thing has been under pressure since the latter part of September. We were at 81 1/4. Here we are at 78 1/4. So pretty bad 6 weeks as far as Canadians concerned. And that happened. It was weak before even the oil market started to turn weak. So, things are not going well in Canada. I mean, we're more interested in climate than we are in terms of the economy.
Was there anything that was in the positive reign of things? Was gold up or down?
Well, if you look at the metals there, the industrial commodities, a tough stretch over there. Copper just got hammered, and that one was down 4% on the day. We're down at 428, having been up in the 460 range not all that long ago. In the precious metals side, we've had a really bad break this week as far as silver was concerned, and actually that triggered a sell signal for us on the 22nd on Monday when it broke below 24.59, and as of Friday we were down to under 23. It was a great week for the options, put options on the silver market. we're up 150 to 200% since we got the sell signal. So pretty nice over there. The one metal that held up reasonably well was gold. Not shining, more of a little lackluster to it, but more of a beige color than a gold color. Up $1.20 at 17.85. Now, both gold and silver sold off enough here that wouldn't be at all surprised in the early part of next week to be looking for an interim low and a decent bounce, but not back to the highs that we saw. Probably looking at somewhere around the $24 level for silver, and it's at $23.10 as of the end of the week.
How were treasuries doing? Were they positive?
That was the one spot that really shone here. The bond market, long bonds, up almost 3 points on the day, 162 and 28/30 seconds. The 10-year up 1.5 points. So clearly the flight to safety, if you can call it really safety in the bond market, was about the only thing that was doing well. So you would normally see a flight to U.S. dollars as well, but that did not happen. Dollar index was down about 0.8%. And as we mentioned a week ago, that got up into overbought territory on our weekly signals just 1 week ago, pretty much due for a correction. And we had a nice breakout at 94.5, ran to 97. Wouldn't be at all surprised to see support in here back around 95.25 to 95.5. Still think that U.S. dollar is in an upward trend, and this would be just a normal correction here.
Ross, do you have an early Christmas gift for our listeners?
Yes, this would be a Black Friday special, and we'll carry that through into the first week of December. 25% off new subscriptions, annual subscriptions, and if people are interested, they could try out just a 2-month trial if they want, but the best deal is to take the 25% off an annual subscription. So that would be at chartsandmarkets.com, and we welcome you to come and have a look.
Ross, thank you so much for the update.
Always a pleasure to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can also find him on Twitter at Charts by Ross. Coming up, Danielle Park, next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, jugglingdynamite.com and venablepark.com. Welcome back to the show, Danielle.
Hey, thank you, Jim.
Danielle, I'd like to start off the show with a question we got from one of our listeners, Al, and he wants to know, will higher mortgage rates lead to lower home prices?
Absolutely. We'll have to. Now, I'm not sure that we're going to get remarkably higher mortgage rates in the next year or two. I think that the problem is that people are so fully loaded on record levels of debt again. If you look at the Bank of Canada households, the financial stability report that came out from the Deputy Governor this week was just reviewing the fact that although we had this benefit from the, stimulus checks and government handouts at the beginning of the pandemic, which really filled up savings accounts in Canada and America and many countries, like boosted the amount of cash on hand that a lot of households had, that benefit has now pretty much evaporated, and we see that savings rates are back to where they were in 2019. The problem is that, of course, in places like Canada, because we've had this 30% pop in housing prices nationally in just the last year, we now have record indebtedness and mortgages for households. So what people, I think, miss there is that, it's one thing to say, well, mortgage rates have come down. Let's just take an example. From 1990, mortgage rates that were about 12% have come down today to less than 2.5. During that time, however, the average household income, which was about $55,000 in 1990, was relative to an average house price at that time of around $130,000. So about 2.5 times household income was a typical house. And even if you only had 10% down, you were taking out a mortgage for like $120,000, and that would be about, even if your mortgage rate was at 10.5%, you were paying about $1,162 a month over 25 years. And your total cost of purchasing that property, including interest, was about $330,000 over that amortization period. You fast forward to today, and the interest component, yes, has come down, as we said, from 12 to 2.5%, huge reduction. But at the same time, the principal portion has ballooned beyond belief. So now the same kind of average stats, if you take a $789,000 average home price in Canada today, that's about 5.7 times the average household income, relative to 2.5 times in 1990. And if you look at, if you're buying in a lot of places, homes are more in the $1 million range. Even if you have a 20% down payment, which is considered, so rich for so many people, they think, oh, a 20% down, that's great. You're still carrying an $800,000 mortgage, which is, 579% of the average household income. And over that same 25-year period, your payment is $3,520 a month for this house that you could have bought for $1,162 a month when interest rates were much higher. And over the course of your life, you're going to pay about $1.2 million for that property, including the principal portion and the interest. So it just goes to show you that a shelter is still a shelter, and all this has really done is put us in this precarious over-concentration on real estate, both in terms of net worth, in terms of economic development, and in terms of the entire globe has had this phenomenon happen. This is the supposedly gift of low rates has actually not helped at all, because what we found is it hasn't reduced servicing costs over the last 30 years. These falling rates has actually led to more higher indebtedness and higher servicing costs when you consider the principal portion. So this means people are paying for their shelter for years longer. They have that much less ability to save for everything else. They have that much less ability to spend on everything else. And this is, as I say, a global phenomenon. So when you look at the McKinsey report that came out this week, looking at the impacts of this on a global basis, they found that only 20% of the investment in the world, or the net worth on balance sheets globally, is now coming from from productive investment. So like machinery, equipment, patents, things that actually improve cash flow in the future and or reduce costs and waste. Those are what productive investments are, things that make it easier over time to meet one's commitments and save money. That's what an investment is. But actually, if you look at the balance sheets of the world now, they have become entirely concentrated in this highly levered real estate. So financial assets and liabilities have grown together because they are mirror images of one another. If you add the debt, you get this increase in the price, and this bubbling of prices up has really tripled global net worth in the last 20 years. That all sounds great, except when you realize that 2/3 of that now is based on these elevated realty prices, which are highly leveraged. And so that is the portion of the economy that isn't going to help us in terms of repaying the debt that's been taken on, because it's not productive. It's just a shelter. It's dead weight. It's cash that has to be now paid back, and interest costs that have to go on for many years. And so you're left with the potential for, if you get a mean reversion in terms of what's normal in terms of the appreciation, typically real estate has gone up roughly in line with inflation plus a couple of percent. And what you see is that over the last couple of decades, it's gone up, much more than that. And as I mentioned, a ridiculous 30% just in the last year in some places. So just getting a reversion to the mean there would wipe a third off of global net worth. So the balance sheet side, right, take a third off of these ridiculously inflated asset prices, but the debts would still be there. So you're really doing a double whammy in terms of the wealth or, ability to service payments and maintain the status quo. And this is a global economy. So we've mentioned before, for example, that, in past real estate cycles, for example, in Canada, residential investment has peaked out at 7% of the GDP growth. In other words, that we've contributed about 7% maximum at the peak of the 80 and 1990 real estate cycle. Today we're at 10.5% of our GDP is coming from residential activities, commissions, transactions, this sort of thing that's going on. So it's more than 4 standard deviations above the long-term mean. So anybody that understands anything about math knows that that's ludicrous and that it cannot continue and that the path of least resistance will ultimately be that prices have to come down over time. And, now as I say, we've lost the benefit of that cash in the bank because people have done so much durable goods spending in the past year, and done so much putting cash down on more or extra home prices. 25% of the buying that has come into the market in the last year, this was again in the Bank of Canada Financial Stability Report, says that it's from this, quote, investor class, which are ultimately, again, not buying these properties because it makes economic sense on an investment basis in terms of cash flow. Like they're not looking at it going, I can put down this money and make a yield of, 5 or 6%. They're looking at it like, well, yields are terrible elsewhere, so I'll put it here and hopefully it'll go up 20 or 30%. And they're literally banking on that. So we have these websites and services now that look at supposedly advising investors, looking at, if you put down X, it's going to be worth, 20% more a year from now, and then you'll be able to lever that up and buy another one. This kind of thing is what's passing as a, investment savvy today, and it's absolutely bonkers. So we know that the loan to income ratio so there's the investor class, but there's also the first time home buyers or people that are trying to stretch themselves to get into these markets. The loan to income ratio, which is considered extremely high risk, is 450%. And now something like 25% of Canadian mortgages in the last year are at this extreme 450% loan to income ratio. And so it's just, there's nothing good in these stats. It just suggests that we're going into a period where we're going to pay heavily for this excess. And people are going to realize that, paper increases in assets are not durable or lasting, and especially when you're at these multiple standard deviation events and, bubble highs and everything. And then, of course, once the bubble bursts and the price declines start, we're going to have a much deeper downturn in the economy, not just in Canada, but globally, because it has infected far and wide the same kind of behaviors. So what I think is more likely is that this period of inflation that we've seen, that has been driven by some bottlenecks in the COVID fiasco, but also just because people went crazy with government money spending this extra cash they had in the bank on goods, and because services were largely unavailable, they really doubled down on goods. Great. So it drove this unusual bump in demand. We're now seeing that supply is quickly coming, right? They're finally getting things unloaded. Inventories are starting to build up. And we've got this plunge in expectations of buying from consumers. They're coming in at 1980 style lows in terms of their plans to buy more cars and more houses. And these are largely American data, but we're seeing it in the Canadian data as well, where people have they've just bought themselves out, either borrowed to death or just satiated the demand that they had, and now they have less and less expectation or interest in buying more of those hard goods. At the same time, we did not see the bounce back in the services sector. Many optimists were saying when you start seeing a drop in spending on the goods side, don't worry, the services side will take over. We're not seeing that, partly because people, as I say, have drawn down their excess cash, and they're now sitting there with even more debt to service than ever before. And it just means they have less capital to put into anything else. So I think more likely we're going to see a moderation in the inflation rate as we head into 2022 because these anomalous factors are coming out of the picture. And that means that although there's been this, expectation that the Bank of Canada and the Fed are going to triple their policy rates from 0.25 to 1% by the end of 2022. In reality, we've seen this play out so many times. As soon as there is they may get a hike in potentially by the spring. I mean, the Feds and the Bank of Canada are expected to go in April and May by a quarter point. But if we get any sort of wobbling in asset markets, we know that they're going to recant on that commitment to raise rates because we've got such a highly levered economy. They're not going to carry through with it. They're going to blink and they're going to go back to trying to ease. They're already saying that, the Bank of Canada's already tapered its bond buying, and the U.S. Fed is intending to decrease it by $15 billion a month going in so that by June. So they're trying to do both things at the same time. They're trying to remove the excess liquidity they've been pumping in to financial markets through these bond purchases, and they're also saying, and we're going to raise rates, from quadruple them over the next year. I just think it's highly unlikely they're going to get there because the asset markets are going to wobble way before that, and we don't have the resilience in the rest of the economy to take up the slack. Not only that, but oil prices have been moderating, as we saw the strategic reserve agreement for all these developed countries to release some from their reserves. That's a token gesture, but it's still a gesture. And we've got the OPEC taking 400,000 barrels a day up to their quota in January, and already we've got now forecast for we've got rising supplies, inventories of oil, and we've got expectation that we'll be in a surplus again globally in 2022. So that's another factor. Although it's backed out of the classic inflation measurements, it goes into a lot of products and goods and services, right? So inflated oil costs have been one of the aspects underlying the price pressure that we've seen. And we're just going to see that come off as it has. It's off about 8% from its peak this month already. And I think that will continue to deflate the inflationary pressures, and that takes off some of the pressure for the rate hikes that people have priced in right now.
A lot of people are using their home equity to invest in the stock market. Is that a concern?
Well, think about that. Not only people, but we're seeing that. I put an article on today on the blog about the California Public Employee Pension Plan, which is it's like almost a $500 billion pension plan, but it's got deficits, as all pension plans do, because they haven't been funded properly, and they've been in this wild west of asset booms and busts for the last 20 years, where yields have been pathetically low because prices have been too high. And so they're having a hard time meeting their commitments. And instead of bumping up contributions, of course, everybody said, well, let's take more risk. Let's put on some leverage. So they're borrowing funds. So just like the households that you mentioned, they're thinking, oh, great, I've made some equity in my property in the last little bit, so I'm going to borrow against either through a HELOC or a line of credit, sometimes on their credit cards, and I'm going to go over here and buy, financial assets. And it all looks great on the way up, Jim. I get it. It looks like easy money, right? You're not even using your money, you're borrowing it, and therefore your return is magnified. What people miss is that the returns work exactly the opposite as soon as asset prices begin to weaken, where you lose your shirt in very short order. And so it's really what people should be doing is using the opportunity of low rates to pay down their debt, to pay off their house, to build up their savings so that they have a cash to actually buy when things are worth buying, when investment quality comes back after prices have come off. But they're doing the opposite, and that means that they're going to be selling in a panic into all kinds of stress and solvency and liquidity problems as soon as the economy wobbles again, as soon as we get this. Don't forget, we're getting a huge fiscal drag coming into 2022, where all of the major economies in the world are coming, the governments are taking their foot off the pedal because they can't keep printing emergency trillion after trillion after trillion indefinitely. And if they're, if we're saying that that we're through the worst of the pandemic, or that we're starting to see the economy recover, they really can't justify continuing to do that. So just that alone, the fiscal drag means that we're going to see a slower economy in 2022. We're going to get a mean reversion back to where we were really before the pandemic. We were growing at about 2%, which was historically half the rate than, the prior period leading into 2000. We would grow considerably more than that. But as we keep adding debt at every level, we just slow the economy, the long-term prospects, the cash flow available for future investment. All that comes down over time, and that's what we're seeing. So this crazy mania of use, cheap credit to buy assets and make yourself wealthy is not long for this world. The historical precedents are unequivocal. It never lasts and it never ends up net benefit because nobody ever actually sells and takes the profits and, puts the cash aside. They just keep thinking that this is a perpetual, endless, roulette wheel, and they just keep spinning. And of course, it ends up in the usual way. So I think it's a sign of the times. It's not just, as I say, households that are doing that. It's pension funds that are trying to get around the fact that they have too little capital and too little contributions and too many obligations by borrowing money to lever up. We've got a record amount of ETFs and funds that are using leverage. We've got a record amount of call options, which is again a form of leverage in financial markets. We have a record amount of margin debt, more than we've ever seen in history, where people are borrowing against their portfolios to buy, to consume goods, to go on trips, to buy whatever it is they're trying to pay for. So again, this is a house of cards. And what you've seen in the last little while is, although the stock market, the main indices have been making higher highs, they've been doing it on less and less breadth, right? Fewer and fewer participants are holding it up. And as of right now, you've got that top 5, stocks, the old Facebooks and Amazons and Apples, the Microsoft, those top 5 companies are now accounting for top most expensive companies is what I mean by that. They have the most expensive market capitalization. They make up about 24% of the broad S&P 500 today. And again, that is far and beyond anything we've ever seen in the past. The peak at the tech bubble of the top 5 holdings was just under 17%. So we're way beyond that. And under the surface, what you're finding is more than 175 companies in the S&P 500 have already, fallen, are already in a bear market. And so the rest of them are starting to succumb. And if you look at the ones that were really super hot in 6 months ago and all the retail crowd was using leverage to buy them, you see the things like, Zoom and Lyft and Twitter and PayPal and, all these basic Robinhood. We've talked about Robinhood before, which was an IPO this year of the online trading platform. They're all off between 30 and 80% just from their highs in the last few months. So I think that we're starting to see, as I say, erosion under the surface of euphoria. And if people don't, notice the signs of that or take the evidence of that, just because this cycle has gone on so much longer than normal and has been so crazy, people have truly forgotten that it's still a cycle.
You recently posted on your blog about battery cells made with recycled metals. Is this likely to lead to the greater acceptance of electric vehicles?
Well, I'm pointing out that so basically there is no question, the data, the studies, everything has confirmed that electric vehicles in terms of power at the wheel are much more efficient than ICE engines, right, than internal combustion. So it's a much more efficient mode of transportation. The difficulty is, the batteries, right, because the batteries are energy intensive to create and they are they have an environmental footprint in the current ways in which we make them, which can offset some of that benefit. Now, the University of Toronto has done a study that shows that at 24,000 miles, EVs and ICE vehicles actually are neck and neck. So in other words, yes, the battery component sets EVs behind for the first 24,000 miles, but then they start to pull ahead, and for the rest of the life of that vehicle, they are a much more environmentally efficient and energy efficient mode of transportation than an ICE vehicle. So they do still, with their current technology, kick the pants off of the ICE vehicles. But the point is, human ingenuity is constantly focusing on how to evolve the battery technology. And indeed, there is a lot of room for improvement there, because if we're not doing virgin mining of the minerals and metals required to make batteries, in fact, we are recycling the components. Obviously, the footprint, the efficiency, that point at which, EVs beat the other vehicles in terms of the tipping point will be much lower. And indeed, we're seeing companies around the world really doubling down on this as a moonshot for, the next decade, is how to make these storage systems, these energy storage systems, batteries in all its different forms, better and faster and leaner and cheaper and less polluting. And so, of course, there's several companies which are registering new technologies, but also about looking at ways to recycle the components. And in doing so, they solve this whole issue of the rareness of certain minerals which are currently being used, or metals that are currently being used in batteries. And yes, it's not something that is instant overnight, but there is a lot of progress being made. And I would suggest to you that just as no one understood what computers were for before they came, no one understood why anyone would need an iPhone or an iPad before they started to get them, I think the same thing applies with battery technology. No one can envision right now, very few people can envision right now, where we're going to be 10 years from now in this technology. And the ones that do have a really firm sense of the science and the exponential rate at which we're evolving this stuff are quite optimistic.
Do you invest in companies that focus on a green economy?
Well, we don't do any individual company investing in our portfolios. We do ETFs and indices when we want to participate. So at this point in this cycle, we're not buying that, because we're not buying equities in particular, and any form of equity is basically vulnerable because, again, we've had a lot of hype and money chasing after basically every kind of, quote, security or asset in the world in the last few years, and that has made them all very inflated and vulnerable to the downside. So, again, I always make the distinction that great technology can be a horrendous investment when you buy it at the wrong price, right? And we've seen that time and time again. So just because some of these shares, for example, have tanked by 50 to 80%, the ones that survive doesn't mean that their technology won't still be good. It doesn't mean, for example, just because I think Tesla's stock is in a monumental asset bubble and will see an enormous correction at some point, it doesn't mean that their cars are not excellent if you want to buy a car. So I'm just trying to make a distinction between the technology and the investment thesis, because they can be very separate, and right now they are very much polarized between good value in the product potential, service, and terrible value in the price that's being offered for investment.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.ZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Danielle Park. Danielle, inflation continues to be the big story, and you've answered a bit of this question, but what do you see ahead for inflation?
Well, as I was saying, I think it's going to moderate. I think that we may see some more price pressure in the fourth quarter here, but again, fuel costs are coming down in 2022. The fiscal push is reversing in terms of cash flow and demand in the economy. We're seeing a reversal of the liquidity from central banks. And I think that all of the asset inflation, the commodities inflation in particular, which has been largely driven by both a backup in the sudden demand shock that came from the pandemic, but also in all this excess capital that had nowhere to go productive, and so it flows into financial assets. And we've seen a lot of that inflation in those constituent parts, which drives up everyone's expectation or sense of where inflation is. So as the asset markets come down, you get an evaporation of that pressure, and it's magnified by the fact that everything's so levered. So I think that we're going to see a correction, and that means that the likelihood of all the interest rate tightening that people are currently pricing in, I think, is unlikely. That's why I'm more optimistic, for example, on government treasury bonds as we head into 2022. They've sold off some since August, which means you can buy them now with yields that were higher than you could a few months ago. And they're still relatively low for sure, but if you look around the world, the thing is that North America now has some of the highest yields on the safest credits of anywhere in the world. And when we're talking about global capital flows who are seeing stuff like, credit stress in Asia right now is very high. The money is flowing. There's a lot of the shifting under the surface of that highly levered property markets in places like China, where again, it's been this ridiculous, 29% of GDP has been supported by money allocating into the property development sector the past few years, which has made that economy very tenuous in terms of its reliance on this booming asset prices. We're starting to see home prices come off in China because there's been this crackdown on credit expansion in the sector. And so there's money now looking to retreat out of some of those other areas, and there's only so many places in the world. If you don't want to, take on more capital risk, where can you park? Where's a harbor in the storm? And that's where you get funds that tend to flow back to the safest possible yields. And that's why, as that happens, you get treasury bonds starting to rise in price again. And I think that that's all part and parcel of what we expect. The other thing we've noticed, of course, is the U.S. dollar is back at a 52-week high this week. And that's, a lot of people were not expecting that, but that's part and parcel of this, the commodity sector coming off, and many commodities have come off significantly in the past few months. That's part and parcel. The other side of that is the U.S. dollar rising, because 82% of the world's commodities are priced in U.S. dollars, so you get that teeter-totter effect. And as the U.S. dollar rises, commodity prices come off, inflation comes off in that process. And the strain builds on foreign borrowers in U.S. dollars, which is another deflationary impact, because a lot of people use the opportunity of cheap rates and Fed liquidity and, the dollar as a place to borrow funds cheaper than they could borrow it in their home countries. But the inverse of that is now we have more debt in the world than we've ever had, and you've got the currency strengthening. So as the dollar strengthens, debt repayment becomes even more difficult. Even without rates rising, it's more expensive to fund your debt. At the same time, you're seeing less capital flows going into those other economies, emerging markets, that sort of thing, which means they have less money to pay their bills. So all of that really is a deflationary effect globally, and that tends to send funds back to places like North American government bonds and U.S. dollars.
What do stock markets tend to do during periods of inflation?
Oh, well, actually, that's the other thing, is that it's not good for stocks either. So it's really ironic when people talk about, we've had this hyperinflationary period in asset prices, as I spoke of, when inflation was, in the 2% range and slightly above. But now you've got a position where if they're correct in saying inflation's going to take off and continue to gallop forward, that's actually historically been terrible for the stock market. You have an S&P yield today that is 1.2%, which is below a 10-year Treasury yield. So at some point, it just becomes so grotesque in terms of risk and so little upside, so little yield, that even, the most euphoric players start to look to take some of that capital off the table. And historically, as I say, high interest rates have not been good for the stock market. It attracts capital back to things like bonds once yields are higher. And we saw, for example, similar conditions in 1969 where inflation started to take off and the stock market was at an all-time high in terms of similar, not as bad as today, but sort of similar in terms of valuations and extreme excesses and concentration and that sort of thing. And indeed what happened, the stock market went into a swoon and really took about 13 years to recover. So kind of what we saw after 2000 when everything collapsed and you really didn't see a recovery in many of the names for years thereafter. That's the kind of environment I think we're heading into.
Is China's economy slowing down more than people may realize?
Yeah, well, so back to what I was talking about, their property sector. Again, they've had this disproportionate concentration on property development and borrowing and levering and trying to get, a lot of individual Chinese households can't even afford to live in the properties that they've been encouraged to borrow and buy, and they've been doing it as a land bank or a place to put funds as a gambling mechanism. Not that it makes sense for them to buy it or try and rent it out because the rents don't cover the costs. Not that they can afford to live there themselves, but again, that they see it as some kind of an investment activity. And so, as the government's cracking down on the extreme leverage, and that's one of the reasons why you're seeing a slowing in the economy, there. And, China Beige Book analysts are some that I follow who have a very good, finger on the pulse, so to speak, on the ground in China. And they're just noting that they are seeing this, again, for the same reasons. The demographics are terrible. The single child policy has left a country of aging people, not enough young people, not enough upward mobility opportunity. You're getting a growth rate there that, was north of 8 in 2008, coming down to, they've tried to maintain, officially reported at 6, but as we go into the next decade, it's likely that growth rate will come down much more towards a 2% range, which is more typical of a developed economy in this environment. And the problem is they have all the debt still to service, right? So if you don't have a lot of immigration, which they don't, and you don't have a lot of births, which they don't, you've got this aging population, and they have a lot of like the rest of the world, these asset bubbles have created this real extremity between a certain fraction of the population that has benefited from these rising balance sheets and the rest of the world, which have been largely left out because incomes have been flat through this period. And so you've got this growing instability, which I think is concerning the Chinese government very much because they don't want to have, insurrection and topple their regime from within. So they're really trying to mitigate that, and you see the government making sort of policy statements in favor of trying to do more income sharing and rather than concentration, and going after some of the big companies like Alibaba, for example, and really making a spectacle of the entrepreneurship or the concentration of wealth in some big names. So all that is likely to slow the economic growth rate in that economy, the world's second largest economy. And I think that they will have ongoing financial stress and strain as this leverage comes out of their system as well.
The throne speech was this week. There was very little about the economy or government debt in it. Is that a concern?
Well, the throne speech is, it's a pomp and circumstance. It's really not anything relevant because the government and the Bank of Canada basically at this point have watched over, as has most of the world, the billowing of these unsustainable financial bubbles. And now no one knows what to do, right? Because they can see that a burst is inevitable because there is no other prospect where you can continue to have this kind of gain to the upside. And even if things just stagnate, that's a problem, right? When you've got an economy that's dependent upon, even if asset prices didn't come down, but didn't continue to appreciate, you have a problem because so much of the transactions and commissions and incomes that we have generated have been dependent on this one sector. So they're basically in the middle of a rock and a hard place. There's no question that we're going to see another recession in the next even if it's not for a couple of years, and we're going to be the least prepared heading into that downturn than we have pretty much of any time in history. So it makes it very difficult. I think that most people have adopted the the approach of just don't talk about it, don't look at it, and hopefully it won't be a problem. And everything else that they speak about is aspirational, but at this point is not really having much of an impact.
Mm-hmm. Now, the meme stalkers, the Robin Hooders, these are young people, a lot of them working out of their parents' basement. Many of them quit low-paying jobs to work the stock market and go after these meme stocks. What's their future? Is the sheriff of Nottingham going to show up for the Robin Hooders?
Well, it's been such a, first of all, we've seen that trend many times before, and other market peaks, it's quite typical where people start day trading. And of course, there's a whole world of firms and in the finance sector that live to entice this behavior because they make, money off of their transactions. So it's quite common to see it, but the statistics in terms of who ends up keeping the money in the end are abysmal when it comes to the retail crowd. They are the lambs to slaughter repeatedly. And yes, it's possible that some of them would luckily pick something and have it, go up a lot and they cash out. And if they're wise enough to then pay off debt or buy themselves a house or something with the proceeds, they could have a benefit from that. Unfortunately, most people don't understand, again, back to it's a cycle, how extreme this present cycle is, and they think it's their own acumen or intelligence or that they're following some guru. It's famously been said there's no gurus, only cycles. And so, if they don't appreciate that, then they will end up, back to where they started or worse is the typical outcome where they're left with, nothing but scars and experience for their efforts.
Danielle, in this kind of environment, is there anything in particular a person can do to protect themselves?
Yes, so, they can review their present financial situation. They can lower their leverage. When everyone else is at record leverage, it behooves one to try and have the least amount of leverage you can afford. So that means paying down things. That means structuring your income so that it's as diversified as possible, that you have a savings buffer, that you are not taking crazy outsized risk, that you're not looking to, borrow to supposedly invest in more assets that are at all-time highs, but rather that you're raising cash and setting it aside and keeping an eye on the opportunities that will come out of all this unraveling once it starts. So those are all the counter-cyclical things that people should do in this environment. And if they do them, this can set them up for extraordinary opportunity and buying things when yields are much higher. Because once prices come off considerably, and we saw this, repeatedly through history, but the last time really was in 2008-9 when everything imploded, then you could pick up dividend-paying instruments, for example, with yields of 8, 9, 10% versus, 2 or 3 or 4 now. You could buy things that were worth purchasing on an investment thesis rather than just on a gambling thing. And so your prospects of success or reward over time are, multiples of what they are now. So all that is very exciting, but only if you prepare for it before the masses. And that means you have to do it proactively and not be there going over the edge with everybody else.
Danielle, thank you so much for chatting with us.
No problem. Thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, jugglingdynamite.com and venablepark.com. Our conversation took place on Thursday. And that wraps up our show for this week. We'd like to thank our guests, Reaugh Clark and Danielle Park, and thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. Now stand by for a company showcase update from American Manganese President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to Company Showcase.
Well, thanks a lot, Jim.
Larry, the markets in U.S. and Canada had over a 2% correction. Is that a concern to American Manganese?
It's a short-term concern, I think. It's the reality is we're in the right area. EV cars sales are going up, which means more batteries, which means more scraps, which means I think we got a great future, and we don't talk enough about the green aspect of that. The green aspect is that, we return nothing to the environment. We have a closed-loop solution. It's been well-tested over a period of 5 years, and we're stepping up to the last hurrah, and I hope to have some kind of a press release, maybe even with a little bit of a timeline on it, on next week. So we're helping the environment, and that's not, you don't see enough of that out there. All you see is that we're recycling batteries. Most people don't realize that they're going into a smelter, and they don't have the complete solution. And some of the ones that do are still contaminating 5 to 10% of the environment by not being able to process the entire battery or the entire scrap material. So that's the one area I think that one of the areas that we lead in, aside from the recoveries and the purities of our product. So that's a great thing. And I don't think companies are getting enough credit for that, and certainly we're not. We've taken a beating on the market in the last in the last couple of months, I guess, and it's not a good feeling. Like I think in the last week I'm down $700,000, and that's not a good feeling. But I'm not worried about it. Somebody wrote me today and said, what can you do? Can you do a deal? Can you do something fast? Can you do this? Can you do that? There's, things happen as they happen, and I don't have a crystal ball. I feel like there's potentially a deal on the horizon. But aside from that, I can't really say when or where. It'll be just as exciting to me when we see that somebody is wanting to do the deal, an announcement that would, one of the OEMs or something like that is in operation today would be a terrific way for us to, start December. But I can't say that that's going to happen. And, it's something that when it does happen, we'll get an email or a phone call, and we'll sit down and huddle on the deal, and we'll see what we can announce. But it's not happening at the moment. And I know there's a lot of guys out there that have lost sight of the fact that this is an advanced project. That this is not something on the drawing board. It's an advanced project. We've proven what we've said, and it's very transparent. And the company is loaded up with cash and has a clear view to commercializing. There's nothing we can do about these COVID shutdowns or the rains here in the Lower Mainland that flooded everything out, and so transport is a little bit slow. But we're hoping to have all our long lead items in by the end of the year, so that we can get started, building out the plant and producing from it. So that would be the demonstration plant, and you just keep going. I can't, I feel sorry for those guys. I know how much money I'm down. But I look at it this way. One guy said, well, I was looking at this as my retirement. Well, so am I, but I'm looking at a hell of a lot better price and payout than there is today, that's for sure. And it's, I know what we got, so I'm able to sleep at night. And, I know that markets are markets. They go up or they go down. And, right now, we're going down. And another guy wrote that, the predators are out of the market. Well, just because I'm not talking about them doesn't put them out of the market. To be very honest with you, the predators hate my guts, and I'm the only guy that shines a light on them every so often in my podcasts, and so they're not happy with that. And but they're live and going strong on the predator side of the trading for ever since I stopped talking about it. And they can hate my guts all the way to the poorhouse, as far as I'm concerned. I'm not concerned about how much they hate me, well, as long as they don't put a hit out on me. But right now, it's got nothing to do with me. It's nothing to do with the great advancements we've made. It's all to do with the bullshit they can spread on the boards, and it's always about what we haven't done. And I guess they forget that we do have an MOU with Idelvolt, or we have a potential MOU with Idelvolt, and that by itself would be worth over $120 million just in scrap value a year. So, all I can say is that, you have to go back and read about the company. It's not a startup. It's not something that's failed in the testing. It's not something that's broke out of money. It's the fact of the matter is the company's in good shape, and we can ride out this storm, and there's probably a lot of selling going on people taking their losses for tax reasons. And hopefully we'll be buying back in again before December 25th. So it's just that kind of a market. I don't blame the guys for getting concerned and worried about the stock, but they got to remember there's two types of stock out there. There's stuff that has strictly got hype on it, and there's companies that have real solid fundamentals behind it, and this company has a very solid fundamentals behind it. So I just want the guys not to worry too much. If you don't need the money at the moment, then you have to make a decision whether you want to sell or not. I'm not going to tell you not to sell. I'm not going to tell you to buy. It's I don't know where the buying entrance will be, but I think we're very close to it. So that's my podcast for today, Jim. And it's a bit of a rattling day, and the Dow is down almost 1,000 points, while the whole market right across the board in the U.S., which closed early, was down over 2%. And so that's and I noticed that the price on the QB board for AMY was down considerably today. It really took a beating, because I think that was because they knew that the market would be closing early, and they wanted to have a low price, and so they could manipulate the Canadian side. So, and it is manipulation, and it is predators. They're the ones that are taking the money out of your pocket and put it into theirs. That's all they're there for. They're not there to help the company. They're not there to raise money for the company. They're there to stop the company from advancing so that they can clean up. And but we're way beyond that now. They caused a couple of market runs back in August of 2016, and then starting in December, late December last year. And that was because they lost control of their short position, and they had to start covering. And the Robinhood guys recognized what was happening, or had been planning it all along, and the stock shot up. So this time, once again, it'll shoot up, because these guys think that it's like trying the same thing over and over and over. That's a sign of insanity, and getting the same result at the end of the day. But anyway, they can go to bed and throw darts at my picture if they have one, or my name if they just want to write it out. then they can do that all weekend. As far as I'm concerned, it's the old saying, "Sticks and stones may break my bones, but words will never hurt me." But they do hurt the shareholders, and I don't like that. And that's why I talk out against them. I do that for the shareholders, not necessarily just for myself, but I did a lot of studies on those, and there's a lot of crap going on in our market that shouldn't be happening. So, Jim, you have a good weekend.
Larry, for people who are new to American Manganese, what's the company all about?
The company's a critical metals company that developed a patented process for treating of very low grades of ore, of manganese, and that was in the 2 to 3% range. And the aha moment came when Cometco recognized that the chemistries could be the same for the cathode materials and the lithium-ion batteries. And we went to work on that, and we've never had a backward step. So that's the cornerstone of the lithium-ion battery recycling. So we did have a big jump on everybody, and we've maintained that. We've gotten the patents, although people like to downplay patents. That's not true. And they'll find out at the end of the day that screwing around with somebody else's patent is very dangerous. And so I hope that nobody's doing that on our patents. And if you want to follow us, we've been very transparent on everything that's happened in the company. Our press releases and PowerPoints and everything are on our website, AmericanManganeseInc.com. I find that most people don't even bother reading that, but they read the billboards. That's the last place you want to go for the truth. And or else you can phone me at 778-574-4444, or you can email me at LREAUGH@AMYMN.com.
Larry, thank you so much for the update.
You're welcome, Jim.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. Our conversation took place November 26th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.